Alright, this is chapter 9. In short, forex. Foreign. Alright guys, pay attention. Foreign means of another country. Foreign. Alright, let's do this. Currency means money used for payment. So, currency has the meaning of money. Currency means usually money issued by the government. Currency is basically same as money, whatever is used for payment. So currency as money is used for payment. So from here you have foreign. Currency is the currency of another country, the money issued by another country. Foreign currency is exactly the same as foreign exchange. Foreign currency is the same as foreign exchange. Okay? Next one is alright, enough, okay? Exchange rate. Exchange rate is the price of one currency relative to another currency. It is also the ratio between two currencies. Okay? It's the ratio, it's the price. It's the price of one currency relative to another. That's the exchange rate. Currently, the exchange rate is here, locally, the local currency is 4,000, how do you call it?
Real.
Or 4,000 real is $1 US. So, a different way of saying is that dollar to real is 4,000. Okay. So the exchange rate is just a ratio between two currencies. And the exchange rate is usually a number. Okay. The exchange rate of the euro, and we always have to say, when you use an exchange rate, remember, exchange rate is always between two currencies. You must always say against what? You can't just say the euro is 115. You have to say the euro is $115. Or euro to dollar is 115. So you always gotta specify what is the other currency. Next. Okay, well, foreign exchange is often shortened for easy pronunciation as forex, coming from foreign and exchange is forex. Okay. Next one is foreign exchange market. Is a financial market where currencies trade. where currencies are exchanged. The next one is foreign exchange risk. And this is the risk of a loss from changes or movements in exchange rates, or the risk of a loss from movement in the value of foreign currencies. Okay. The value of the currency, foreign currency, can go up and can go down. If it goes down, we call it
Depreciation.
depreciation. Depreciation is a loss of value. So you will have a currency depreciation, is a fall of value in a currency. The opposite of depreciation is
Appreciation.
appreciation. So, foreign exchange risk is the risk of loss due to depreciation or appreciation of foreign currencies. Next. Currencies are usually not traded on exchanges. It's OTC. OTC is over the counter. Over the counter. This means there is no organized exchange. Each financial institution will deal in currencies. So you get what's called a currency dealer. Will be a dealer in currency. The dealer will hold, it's called the currency which they hold to trade is called inventory. It applies to stock dealers. When somebody deals in stock, they'll hold stock in inventory. Bond dealers will hold bonds in inventory. So, a currency dealer will have yen and euro and dollars and whatever currencies they deal in, and they'll hold them in inventory, and the dealer will be making a market. Remember, the dealers act as market makers. They will offer a bid. They'll have a bid, they'll have an ask, and if you want to buy, they'll sell. If you want to sell, they will buy from you. And the biggest one are banks. The biggest players are banks. Let's see what else. Exchange rate. Next one is exchange rate systems. Is how, or the government's policy of maintaining the exchange rate of their own currency. In other words, how the government maintains its currency exchange rate. So the exchange rate system could be fixed exchange rate. Fixed exchange rate doesn't mean that the exchange rate is fixed. It means it is fixed to one currency. So a fixed exchange rate will be usually fixed to the US dollar. So it simply means that it may float against the others, but against the dollar it is fixed. Or it could be fixed against the euro. Alright, well let's do this. My own home country currency, Bulgarian lev, is fixed against the euro. So we have 1 euro equal to 1.958. We call it BGN. That's the Bulgarian currency. And it's fixed. It's been like that for 20 years, since 1997. 19 years. This is the exchange rate, and it's fixed. So it's fixed against the euro. Okay. When the exchange rate is fixed in the law, and this is what the legal exchange rate is, we call it a currency board. Currency board means the central bank exchanges the local currency for a foreign currency, and the foreign currency for a local at a fixed exchange rate, and it's written in the law. It's a currency board. So a currency board is a special type of a legal arrangement of a fixed exchange rate. The other alternative is floating exchange rate. The currency floats. The currency changes freely against other currencies. Well, there is one intermediate between these two. It's called quasi-fixed. Quasi. Quasi-fixed is not exactly fixed, but kind of like fixed. It appears to be fixed, but not strictly fixed. Quasi-fixed would be the Chinese currency, the Chinese yuan against the dollar. It's been fixed for a long time to be 640 something. Well, it can change just a little bit, but not much, maybe 0.5%, maybe less than 0.5%. It may change 1%, but it changes very slowly and rarely, okay? So for the most part, the government keeps it fixed close to a small range, okay? Let's see what else we got. Floating, fixed, okay. Well, the market and the currency market over there will be part of, I can actually continue over here for the market. This market, over-the-counter market, is known as the interbank. Interbank market, which stands for the interbank currency market, is where major big deals for millions and millions of dollars, where banks exchange currencies between them, are the major participants in over-the-counter exchange market. Now I can go to an exchange bureau and change $20, $50, $100, maybe $1,000, okay? They can do relatively smaller deals, okay? But banks will be the main big currency dealers who will deal in millions of dollars. Let's see what else. You will have currency dealers, but you'll also have currency brokers. when you need to exchange big money, like $100 million or $1 billion, it is not very likely that you're just going to walk in a bank or call the bank and say, hey, I need to change $200 million. And the bank won't have that kind of money to just say, okay, let's go and exchange it. You may have to go through a broker, and that broker may have to find for you 10 different banks who will sell you dollars or pounds or whatever, Japanese yen or whatever currency. So you may need to go through a broker who will help you find all of those financial institutions that are currently interested in changing stuff. Let's see what else we got. Then, over time, you get what's called a currency forward market. A currency forward market is more of a derivative market. It's where you fix an exchange rate today to make the exchange in the future. For example, you're a Honda dealer and you want to import motorcycles from Japan, let's say. And if you're dealing with Japan, you know from the Japanese exporter that he will ship you the Honda motorcycles. Let's say they're going to ship you 100 Hondas, each worth $1,000, $100,000. They're going to ship in about 2.5 months. And you've arranged to make a payment 3 months from now. Well, in a currency forward market, you will fix the exchange rate today to make the exchange 3 months from today when you need the Japanese yen. So they say, we want you to pay us in Japanese yen. So you go today in the bank or somewhere who will say, okay, today we fix the exchange rate at so many dollars per yen. 3 months from today, after 3 months, after 90 days, you go there with the dollars and they'll give you the yen. And then you take the yen and give it to Honda. You make the payment to Honda. So currency forward market is a market where today you fix the price, the exchange rate for a future date. Could be 30 days, could be 60 days, 90 days, or 180 days. So that's the forward market. Okay. The biggest currency market for a long time has been London. London has been, for well over 100 years, the financial capital of the world. So, as dominance for over 150 or 200 years of the British pound declined, the financial center of the world was New York. However, since Americans dealt mostly and entirely with US dollars, you had major exchange of dollars happening in London. So over time, London became the capital of the currency markets. And the forex was done mostly in London with London banks. And later on, you'll have American banks entering in London to do currency, and of course later on other transactions like euro-dollar transactions. All right, let's see what else we got. The second one will be New York. And currency exchanges will be associated with mostly US trade, importing, exporting, and other stuff. Then will be Tokyo, maybe with Y over here. Tokyo will be the next big market. Well, now a big currency and everything related to currency will be the euro. And euro is a major currency, but it could be traded equally in Germany, as well as in France, and of course in London. So the euro doesn't have a very specific location for trading. It's kind of like trading everywhere in the world. Just like the US dollar. US dollar is pretty much traded everywhere in the world. And daily over here, it's getting exchanged back and forth to local currency all the time. Let's see what else we got. Euro and all the other stuff. Okay. Foreign exchange rate. Okay. I did a little bit of transactions. Transaction is where an exchange occurs. And the transaction can be spot. Spot means spot transaction. Transaction occurs right now, at the moment. In a spot transaction, you give the one currency and you immediately receive the other currency. It's immediate, okay? So whenever you go on the street and meaning at the currency exchange, you go and give the one currency, within 5 seconds, they count the other currency and give it back to you. That's the spot transaction. The other type of transaction I explained is a forward transaction, is where today you fix the exchange rate for a future date. So today you say after 90 days the exchange rate will be so much, and you make a deal, legally binding, to exchange the currency after 90 days. It could be forward after 1 month or 30 days. It could be forward after 2 months or 60 days. It could be forward after 6 months, or it could be a 1 year forward. So you just say 1 month forward, 2 months forward, 3 months forward, 6 months forward, 1 year forward. It's possible to be even 2 year forward. So forward means you do the deal today, but today no money changes hands. If it's a 60-day forward, means 6 days from today there will be a currency exchange at the exchange rate determined today. Okay? So that's the forward. Okay, the most common, they say in the textbook, are 1, 3, and 6 months forward. Okay, you have currency brokers. A broker specializes in finding large amounts of currency for exchange. So you want to change $100 million, he'll help you find $100 million. Then you have currency dealers. And finally you have currency traders. The currency traders will take a long or a short position in a currency and anticipating or expecting the currency to go up and down and profit from it. Now, currency could be long or short. You know, long, you own the currency. You have the currency. If you're long dollars, means you have dollars in your pocket or in your bank. You own it. You know, long, you profit, meaning in finance we say you gain if the currency appreciates. In a currency short, you owe the currency. Means you borrowed the currency and must pay back. In a currency short, you borrow the currency and sell it. So to short means to borrow and sell. In a currency short, you profit when the currency depreciates. You buy it back cheaper. Currency traders. Now there are currency electronic exchange and electronic possibly currency exchanges. Okay. Another big currency market, Tokyo, New York. Now another big market will be Singapore market. And one of the big places for currency exchange will be the Hong Kong market. And I'll shorten it to FF, standing for Frankfurt. Frankfurt, Germany. Frankfurt is the financial capital of Germany. That's where the stock exchanges are and the currency and all the major banks and financial institutions. Everything is in Germany. And Germany is the biggest, most powerful economy in Europe. And therefore, Germany represents the center of European economic, financial, and historically military power. Okay, so Frankfurt will be a representative for Europe. For Asia, that would be Singapore and Hong Kong. And now, over the last 10 years, rising close to the very top will be Shanghai. Just 10, 20 years ago, Shanghai was a relatively small financial center. Now Shanghai is already ahead of Tokyo and pretty much ahead of Singapore and Hong Kong. Shanghai is probably the second or third financial center in the world, and that's come in recent years. Let's see what else we got. So who are the major players in currency markets? There is a special type of a financial institution. Probably we'll cover it in a couple of weeks. The biggest player will be banks, commercial banks. And the biggest type of commercial bank is called a money center bank. Money center banks are huge. They're monsters. They are some of the biggest banks in the world, okay? A lot of money revolves around them, okay? But the main characteristic of a money center bank is not that it's big. Yes, most of them are very, very big. But just being big doesn't make a bank a money center bank. The main characteristic to remember, to know and understand is that money center banks use a lot of borrowed money. So, huge borrowing and very, very few deposits. So, a commercial bank is a financial institution that makes loans and accepts deposits. Commercial banks, most of their obligations, maybe 50, 60, 70% of their debt is deposits. They could be demand deposits or time deposits. Well, with money center banks, they have very few deposits. Some of them don't even accept any deposit at all. So most of them borrow, and they borrow two ways. Most of them borrow on the money market, just the way we've discussed in the money market chapter. So probably 80 or 90% of their obligations, whatever is not capital, is borrowed on the money market, and the rest will be borrowed on the bond market. So that's a money center bank. Well, money center banks will be the biggest players in the forex market. And money center banks, so these are the participants, will be with what we can call major. So major is in big. Commercial banks. So commercial banks and money center banks will be the major players. Let's see what else we got. Okay, long, short, I deleted it. We call this a currency position. Your position is long or short. Currency position. Sometimes it is known as a net position. Net position. Net means you take the longs, you take the shorts, you net them out, and it's the difference between longs and shorts in a particular currency. Now, currency position is important to understand is in one currency. You have two currency, you have two currency positions. You have 10 currency, you're going to have 10 positions. So for each currency, you will have either a long position or a short net position. Okay? So the currency position, the currency net position, is the source of exchange rate risk. It's very simple. The bigger the currency position, the bigger the currency risk. The position, exchange rate risk, okay, we can use another word. Let's use another word. It is called risk exposure. Exposure. Exposure is or means the potential for loss. So risk is also potential for loss. The exposure tells you the size of the loss. The size of the loss. So the currency position determines your risk exposure. The higher the position, the higher the exposure. The lower the net position, the lower the risk exposure. So the exposure tells you the likelihood of a loss. Sorry, not the likelihood, the size of a loss. The risk tells you the likelihood. So risk may be, oh, we got a 60% chance of losing. Well, we got to say, losing how much? Losing $1 million or losing $50? If it's losing $50, exposure is small. Losing $1 million, exposure is big. Now, for a major money center bank, exposure of $1 million is small. Exposure of $100 million will be considered big. Okay? So that's risk exposure. And sometimes they use in the textbook as in position exposure. Sometimes they'll say position exposure. They'll use both. Okay? Let's see what else I got. net exposure, foreign exchange risk. Okay, so now what is net position? And net position is the same as net exposure. Is a financial institution's overall currency position or overall net position for a given currency. Assets in a currency count for long and have a long position, and liabilities count for short. So currency exposure long is associated with assets and short is associated with liability. All right, net long, net short. So net position. So the net position or the net exposure would be net. Net means assets minus liability. Net means subtracting liabilities from assets. Net means counting both assets and liabilities. Liabilities you count with a minus sign. So net exposure could be net long, could be net short. Next will be foreign exchange portfolio. And a forex portfolio will be simply a number of net currency exposures. So a portfolio will be simply a collection of net exposure currency 1, net exposure currency 2, net exposure currency 3, and so on. So a forex portfolio will be a collection of currency exposures to different currencies, euro, yen, and so on. All right, next. Next will be reasons why trade in forex. So, why buy currency? Why sell currency? There are 4 primary reasons. The first one is commercial. Commercial is the same as business. You want to import Hondas, 100 Hondas, you need to pay Japanese yen. The Japanese exporter says pay us yen. You need to go exchange your dollars to Japanese yen, okay? So, for purely commercial. Usually the commercial is associated with import and export. You want to import, you want to export. If you export something to Thailand, okay, whatever you make and export, when you get the Thai baht, you got to convert the baht back to, let's say, dollars. Number 2. Investments. A lot of foreigners, right? Here, I understand, if it's true, that Koreans are big investors. They will get the Korean currency won, convert it to dollars, and over here they're going to buy apartment, open businesses, make construction companies. So you're going to do investment, longer term investment. Number 3, hedging. Hedging. For example, you have a certain crop or whatever. You expect to get your agricultural produce in 6 months. You expect to sell it in dollars. So you will convert your foreign currency revenue to your local currency. For example, you expect 6 months from now that you're going to sell your rice in Japan or in China. You're going to get Chinese currency. You want to hedge when you convert your currency back to local currency or to dollars. So, hedging is associated with expected future net position or expected future net exposure, and hedging is reducing a current or future currency exposure. That's hedging. You reduce your current exposure or you reduce an expected future exposure. One of the main ways, which I just explained a few minutes ago, will be with currency forwards. You expect to import in 3 months. You don't know whether the exchange rate is going to go up or down on you. So you're going to have a currency, in this case it's going to be a currency forward contract, which is a derivative contract. And it will guarantee you today the price for 3 months from now. A different way of hedging will be, again, with a derivative. It's called a futures. A futures contract will always have the letter S, futures. You never say future. It's always futures. And the futures contract is for a standardized quantity. Always, let's say, $100,000, okay? And in the next chapter, I'll be discussing forwards and futures. I'll be discussing derivative markets and the differences between those. Today, the important point to understand is that people participate in the forex market either to trade this trade, actually, let's write it out a little better. We say international trade. International trade will be import and export. International trade. So, it's either for trade purposes, investment purposes, hedging purposes, or number 4, speculative. Speculative purpose is not associated with export or import. It is not associated with investment. Speculative purpose is for the expectation of the price going up or the price going down. The price is the exchange rate. In other words, speculative will be because exchange rate will appreciate or depreciate, and your purpose is to profit or gain from the expected appreciation or depreciation. Speculative, most common, will be traders. Currency traders are those that buy and sell, usually for speculative purposes, expecting to profit from currency. And don't confuse these traders and currency trade with international trade. Currency traders are speculators profiting from buying and selling the currency. These traders are importers and exporters doing legitimate business, importing or exporting rice, importing or exporting Hondas, trying to move commodities across borders. These are just moving paper, okay? Next, based on net position, net exposure, net long, net short, the exposure means that you're open. So you have an open position. And open position now are going back to here. Number 3 is open position. The definition, page 265, for those who have the textbook, right? Not today. 265. An open position is an unhedged position in a particular currency. Unhedged position in a particular currency. In other words, positions are either open or hedged. Okay? So you may have an open position, meaning open means you're running a currency risk. You have a exposure, risk exposure. Or the position is hedged, usually with a forward or a futures. So positions are hedged or unhedged. If it's unhedged, it's said to be open, and it's a source of risk. Let's see what else we got. We got 10 more minutes, right? About.
Yes.
Okay. Foreign exchange risk, I covered this part. Okay, that's very nice. Okay, next one on hedging. Hedging, forward, futures. Okay, I'll do it here. I'll delete the open stuff. We have to move a little bit the camera on this part over here. The hedging could be on balance sheet hedging, and it could be off balance sheet hedging. So when you hedge, you can hedge on balance sheet, and you can hedge off balance sheet. If it's on the balance sheet, it will be, the hedge will be recorded either as an asset or as a liability. It will enter the balance sheet. In an off balance sheet, it is not recorded as an asset, and it's not recorded as a liability. Certain transactions based on accounting rules and principles don't have to be entered. The example of an off-balance sheet will be a forward or a futures. In general, some derivatives do not have to be recorded on the balance sheet, and they will have to be recorded in a, what's known in accounting as a footnote. It's a disclosure. closure. It doesn't enter the balance sheet. So you can hedge. So how you hedge, it's important to recognize. In other words, when you look at the balance sheet, there may be a significant currency exposure, but then you read in the notes what percentage of that exposure has been hedged off the balance sheet. The idea is that certain risk exposures on the balance sheet can be hedged off balance sheet. So you cannot look at the balance sheet and determine the currency exposure. You got to look also what's off the balance sheet. But that's important. You may have, and I discussed this a little bit before, related to off balance sheet. I think I did, right? You will remind me. Contingent liability. Contingent liability is a potential future liability which becomes actual liability if a certain event occurs. So, contingent liabilities are dependent on a particular event. The event could be a hurricane, a tsunami, okay, could be an insurance event. The event could be a financial event, stock market crash. An event could be, most commonly, a default. If there is a default, then the event occurs, suddenly you got a liability. So contingent liability is not recorded on the balance sheet and becomes an actual liability. So contingent liability is off the balance sheet, and when it becomes a real or actual liability, it moves on the balance sheet. So contingent liability is off balance sheet, is not on the balance sheet. And if the event occurs from contingent, it becomes actual liability recorded on the balance sheet. So, you may have contingent currency claims. If something happens, you will have a contingent currency